Interest in ESG has never been higher, and the pressure is on for investment organizations to move toward the sustainable investing model. As the world shifts from ESG investing as a good idea to ESG investing as a reality, it's becoming increasingly important for investment professionals to stay abreast of ESG trends and educate themselves on ESG factors. From institutional investors to retail investors, ESG is top of mind and growing. In the first half of 2020, the Principles for Responsible Investment (PRI) signatories increased by 28%, and the assets under management grew 20%. 90% of investment professionals expect their firm's commitment to ESG will increase, citing the need to manage risk and respond to client demand. Still need proof? The influence of ESG ratings on firms' cost of capital will only increase in the next 5 years. And let's face it, only 5% of investment professionals say there is nothing that would convince them to start considering ESG issues. Are you prepared for the rise of ESG?
Good afternoon, everyone, and I would like to welcome everyone for another leg of CFA Society Philippines webinar. And for this afternoon, our investor series webinar is entitled Investment Policy Statement Webinar. And allow me to introduce myself. My name is Brett Michael Ormanada. I am your host for today's online event. And before we go to our formal event, we would like to take this opportunity to thank our corporate sponsors. We would like to thank silver sponsor FTI Consulting Philippines and bronze sponsor D&L Industries Incorporated. Okay, now to formally welcome us all, please welcome our President and Chairman of CFA Society Philippines for the warm welcome, Dr. Rob Ramos, CFA, CAIA, CIPM, RFC. Dr. Rob.
Thank you, Brett. This is a very interesting event. I think good afternoon to all of you. And the first thing that people want to do is before you start investing for a client, you have to understand the parameters that the client wants to ask you to work with. And that is the main reason why an investment policy statement is very important. So with that, I'd like to thank our speaker for the day for giving his time, sharing his knowledge, and of course, I'd like to thank all of you, of course, for joining us today. Please continue to support us as we go through this investor series. Thank you very much, Brett. Back to you.
All right, thank you so much, Dr. Rob. Now, let me introduce our speaker for today's online event. Raf, he's my colleague from Security Bank Trust and Asset Management Group, is a fund manager, equity fund manager. He's primarily handling SB High Equity Fund and other investment management accounts. Before he joined Security Bank Trust and Asset Management Group, he had stint in RCBC Trust and UCPB Treasury. He traded equities, fixed income securities, and foreign exchange. Raf graduated from the De La Salle University, Manila, with a degree in management of financial institutions. Raf is a CFA charter holder and a certified treasury professional. Now, without further ado, may we call Mr. Raf Palmahil, CFA. Take it away, Raf.
Hi, Brett. Thank you for that introduction. No? So, hi, I'm Rafael Palmahil, no, one of the equity fund managers of Security Bank's Trust and Asset Management Group. First of all, let me share my screen, no, so I can share the slides. I hope everybody can see my screen.
Yes, Raf.
All right. Okay. So, yeah. Actually, when Richel or was it Precious who asked me to talk about IPS, my initial thought was, what can I really discuss about the investment policy statement? It seems so self-explanatory. Like if the client is conservative, then TD. If it's moderate, if it's he or she is moderate, then bonds, and if aggressive, equities. No. But when I started making this PowerPoint, I realized that there was more to it than meets the eye. Suddenly, I was in a rabbit hole searching various topics like behavioral finance, cognitive biases, investment risk profiling, benchmarking, so on and so forth. No? Apparently, the IPS is not just one of the opening documents that the BSP requires us when we onboard a client, nor it's just a part of our DocDef file. No? So I'm allotted 30 minutes. I hope I can cover everything that I have learned about it in the next half an hour. No? So please excuse me as I will close my video first to save on bandwidth. No? never mind. I can close it. Anyway, before anything, let's identify the learning outcome statements that we expect from going through this presentation. No? It won't be a CFA material without an LOS. If you know, you know. No? So first, after the end of presentation, we should be able to define what is an IPS. Compare how the CFA and the BSP defines an IPS. Determine the tools to formulate an appropriate IPS for clients. Identify the elements of an IPS. Evaluate the client's risk need, risk-taking ability, and behavioral loss tolerance. Identify the appropriate benchmark for any given investment strategy. Explain the importance of having an IPS, and of course, to be able to recommend an appropriate IPS for our current and prospective clients. So what is an IPS? So first, let's look at the CFA definition. So an IPS, or an investment policy statement, is a document drafted between a portfolio manager and a client that outlines general rules for the manager. This statement provides the general investment goals and objectives of a client and describes the strategies that the manager should employ to meet these objectives. This definition is from the CFA Institute. However, BSP has its own definition of an IPS. So a trust entity managing discretionary accounts shall have in place a method by which suitability of investment is determined based on the results of the Customer Suitability Assessment, or the CSA, and formulated via an investment policy statement. It shall communicate to prospective clients the results of the assessment. Recommend this investment product, portfolio, strategy, and explain the reasons why, on the basis of the given information, its recommendation is to the best interest of the client as of a defined time frame. The IPS is a clear reference framework for investment decisions and must be based on the investment objectives and risk tolerance of the client. So from what I gathered, an IPS is a collaborative effort between the portfolio manager and the client, not just one of the opening requirements that our sales team needs to have the client sign upon account opening. It is based on the client's goals, ability, and willingness to take on risk. It is basically a guide for or a set of rules for the fund manager to use in handling the client's portfolio to effectively meet his or her goal. So what are the elements of an IPS? So based on the CFA Institute, the elements of an IPS are the following. The first one is the scope and the purpose. Second is governance. Third, investment return and risk objectives. And lastly, risk management. So first, under the scope and purpose, we need to define the context. So it will be helpful for us to have a short context of the nature of the investor, the history of the client, the source of his or her wealth, etc. As this will establish a context to our investment program that we intend to implement. Next is we need to define the investor. Of course, we have to identify who is our investor, whether it is a natural person or a legal or corporate entity, and specify which assets are to be governed by the IPS. And lastly, under the scope and purpose, we have to identify the structure, or define the structure. We have to identify the clear responsibilities of the parties involved. Will the account be trusteed, or will it be under an investment management account? Who will do the risk monitoring and management? And of course, the client needs to signify that he or she accepts the IPS by affixing his or her signature to the document. The second element is governance. So governance, basically, here we specify who is responsible for determining the investment policy, executing and monitoring the results of implementation of the policy, describe the process for reviewing and updating the IPS, describe the responsibility for engaging and discharging external advisors, assign responsibility for determination of asset allocation, including inputs used and criteria for development of input assumptions, and assign responsibilities for risk management, monitoring, and reporting. The third one is investment return and risk objectives. So first, we need to describe the overall objective of the fund. No, example, to generate additional income per client or to fund future retirement obligations, etc. We also need to identify our expected periodic inflows and outflows for the fund. We need to establish the asset classes permissible or allowed, no, for the portfolio to invest in. We need to identify its strategic and tactical allocation as well as its benchmark. We have to define the client's risk tolerance, aided by of course, by the CSA or the client suitability assessment form, and the waiver, no, in case the clients wants to divert from the results of the CSA. We also have to describe the other relevant constraints that may affect the investment. First, define the evaluation horizon, whether it's calendar year or fiscal year, liquidity requirements, any taxes and legal consideration. So it's not just a collaboration between the client and the fund manager. It may also entail discussing with lawyers or tax experts. No? Of course, we need to talk about policies related to leverage, although this is quite unusual here in the Philippines, no, as we don't use leverage for our investment. And then restriction on foreign investments or any foreign currency management requirements of the fund. Lastly, describe the other considerations relevant to the investment strategy. So state the investment philosophy, set up a policy on proxy voting, identify constraints on participation in securities lending program, although not yet applicable here in the Philippines until such time short selling will be allowed. And then identify special factors to be used for adding or removing names in the client's investment universe. No? For example, a religious fund might not want to have exposure to gambling or liquor manufacturing firms. And the last element is risk management, no? So, which is very important. So here we establish performance measurement and reporting accountabilities, specify appropriate metrics for risk measurement and evaluation. We define the process for rebalancing portfolios to target allocation. So this is the elements of an IPS based on the CFA Society. The BSP also has its own minimum elements for an IPS, no, which is quite similar. So I'll just read through it. First one is the client's risk tolerance, investment and or return objectives, liquidity requirements, investment horizon, investment strategy and rebalancing, portfolio construction process, including asset allocation and security selection criteria, investment restrictions like single or group exposure limits, prohibited investments, client's consent for taking losses, and then investment performance review, which are the proposed benchmark or benchmarks and the frequency of performance review reporting. So in an IPS in your firm might be different from another firm. No? So an IPS is quite unique to and is basically a what do you call this, a proprietary document by your firm. No? So I won't show an example of an IPS, but I'll show you how to be able to derive an IPS from all the tools that I will discuss today. No? So it will be different from one firm to another. So how frequent should we review the IPS of our clients? No? Per the BSP, the trust entity shall update the CSA and the IPS at least every 3 years, no, except in the following instances. Whenever updates are necessitated by the client, whenever managers express intention to invest in complex investment product. While the CFA suggests that we should at least review the IPS at least annually, no? And also prior to any material changes. No? So based on what we learned in the CFA exams, no, we need to adhere to the stricter rule. No, so ideally we need to revisit our clients' IPS and CSA at least annually. So what are the other relevant documents that may aid us in creating an appropriate IPS for our clients? No? So of course, there is the CSA or the client suitability assessment form, which basically assess the client's level of financial sophistication and determine the client's risk profile. No? So based on the MORB, the minimum information required for the CFA are the following. No? The first one is personal and institutional data, investment objective, investment experience, knowledge and financial situation, investment time frame and liquidity requirements, and risk tolerance. No? So in the MORB, when you do a CSA, ideally there are only three outcomes. No, first is conservative. So this means that the primary goal of our client is to prevent the loss of principal. No, so typically what we advise the client are investments that are considered cash and cash equivalents. No, like time deposit, short-term government securities. They can also be moderate. So the prospects they would like to be able to have higher returns than traditional deposit products for some level of risk. No? So typically what we suggest are to these clients or to our moderate clients are fixed income securities like GS and bonds. And lastly, if they are aggressive, they are seeking capital appreciation of over time. No? And that's the willingness to accept higher risks involving volatility of returns and possible loss of capital in return for higher long-term results. No? So here we suggest equities like stocks and preferred shares. No? However, the client has the option to reclassify provided that they sign a waiver. No? So in case your client comes up conservative and then they want to invest in something that is more aggressive, then they can sign a waiver and we can allow that. No? Other relevant documents are the risk disclosure statement, which is a document wherein risk associated to a specific investment are laid out for the clients to understand. No? And as mentioned earlier, the waiver. No? Basically, the option to reclassify to a different classification other than what was concluded in the CSA form. So to be able to come up with an appropriate IPS, no, one important thing that we need to do is to do an investment risk profiling. No? So more than all the elements and those things are important, but to be able to come up with a good suggestion to our clients, we need to be able to assess them properly, no, so that we can guide them properly and come up with an investment plan that is suited to each and every client, no. So what is the primary purpose of the IRP process? No, so this ensures that the investment and financial recommendations match an investor's financial and emotional aptitude to engage in financial transactions that entail financial and investment risk. No, so aside from looking at the client's ability or capacity to take on risk, we also need to look at their willingness, no, to take on the said risk. So the three dimensions of an IRP are the following. No? First is the need for risk. So this is related to establishing the investor's goals, no? And the required rate of return that is required to be able to fund his or her future goals. No? This entails looking at the current market environment as well as the interest rate and inflation environment. No? Next one is the ability to take risk, which includes the investor's time horizon, potential need for liquidity, and risk capacity. And lastly, the behavioral loss tolerance, no, which does not have anything to do with the client's bank account, but the maximum amount of uncertainty an investor is willing to accept when making financial decisions. So this is how the CFA lays it out. No? So each and every element is important in coming up with an IPS. First is establishing an investor's risk need. No? So this encompasses the required rate of return, the market risk environment, and the consequence of failure. So just to segue a bit, no, one important thing I learned when starting my career is to have SMART goals. No? So what are SMART goals? So these are your goal needs to be specific, measurable, achievable, realistic, and timely. No? So specific, meaning it's well-defined, clear, and unambiguous. Measurable, so with specific criteria that measure your progress towards the accomplishment of the goal. Achievable, which means it's attainable and not impossible to achieve. Realistic, which means within reach and relevant to your purpose. And lastly, it should be timely. No? with a clear defined timeline, including a starting date and a target date. No? So this SMART goal also applies in creating a goal for our client, no? Or an investment goal for our client. So when establishing an investor's risk need, these three things needs to be considered. No? So the required rate of return. So for example, a client needs 100,000 at the end of the year, and then his principal is 1 million. So the required rate of return means 10%. No? So this refers to the amount of portfolio risk an investor must accept to meet a specific financial goal. High reward, of course, entails high risk and vice versa. So the 10% means that the client might opt to invest some of his or her fund in more risky asset like equities to be able to achieve that specific rate. No. We also need to consider the market risk environment, which is the current and future market environment, which can play an important role in shaping the portfolio development and allocation decisions. No? So, of course, if we need 10% and given the current market environment, we feel that it is not achievable, then we might have to consider the goals of our clients. No? Or maybe change the other aspect of the portfolio, like for example, increase savings, lessen expenses, no? And the like. And then lastly, consequence of failure. So this refers to the financial and emotional threats an investor face if a goal is not achieved. No? So financial advice, the financial advisor might have to nudge the investor to be able to save more or spend less, no? Or work longer, no, to reduce the risk of failure. So that's the factors that we need to know, no, when establishing an investor's risk need. So the framework for establishing an investor risk need, no, so to be able to come up with the ideal risk need for the client, we need to ask the following questions. No? So first is, what is the investor's goal? What is the future value need, or the amount of money that is needed in the future? What is the present value of the investment account? What is the time horizon for accomplishing the stated goal? What is the regular inflows, no, or outflows from the account? What is the frequency of inflows and outflows? What is the estimated required rate of return to meet the stated goal? Given capital market expectations and the current market risk environment, is the rate of return realistic to obtain? And then, of course, you will come to a decision point wherein you can proceed or stop and or revise the goal and the savings rate. And then, of course, what are the financial consequences of failing to meet the stated goal? So actually, there is a framework, no, to be able to know whether the risk need of the client is either low, moderate, or high. No? So once the ROR is established, the financial advisor, the portfolio manager can use this guide. No? So if the fund requires less than 30% to be invested in growth asset to meet the required rate of return, so the risk need is categorized as low. If it's between 30 to 70%, it is considered moderate. Then greater than 70% is considered high. No? So growth assets here are basically risky assets like equities. No? So example, the client's rate of return to achieve his or her goal is 20%. Considering the current market environment, the fund manager needs to allocate more than 70% of its portfolio in growth assets like stocks to achieve the goal. Hence, the client's risk need is considered to be high. Next factor is to establish an investor's risk-taking ability. So this encompasses the client's time horizon, need for liquidity, and risk capacity. So the goal time horizon basically is the period between the goal is established and the date of the goal's achievement. No? Which in some cases may exceed the investor's remaining lifetime. So of course, the longer time horizon, the client has the greater capacity to withstand and recoup losses. No? So we can classify it into short term, medium term, or long term. So anything less than 5 years is considered short term, and anything greater than 10 years is considered long term. So anything in between is considered medium term. So need for liquidity. it is defined as an objective requirement or desire to hold cash for ongoing current or future expected distribution needs. No? So expected or ongoing annual distribution need of 5% or more of a portfolio indicates a high liquidity need. No? So if we are required by our clients to keep at least 5% in cash, it is already considered as a high liquidity need. No? And of course, the absence of any expected distribution indicates low liquidity need or high ability to take on financial risk. And the last one is risk capacity, which refers to an investor's financial capability to withstand a financial loss without meaningfully compromising his or her desired standard of living. No? So this is gauged by the total investable assets relative to the total wealth of the client. So this is basically the bank account or the wealth of our clients. No? Other things to consider are, of course, the cash savings, pension income, insurance, access to credit, and etc. So an easy framework to use to be able to gauge the risk-taking ability of the client is the following. No? So if either of the following situations is present, so the investor's ability to take risk is low. So when the client's time horizon is less than or equal to 5 years, and if their expected or ongoing annual liquidity needs that is greater than 5% of the portfolio. No? So if these two are present, then the investor's ability to take on risk is low. If all of the and if it is the reverse, no, then the investor's ability to take risk is high. No? So for example, the time horizon is greater than or equal to 10 years. The investor has no expected and ongoing annual liquidity needs. The client has sufficient outside income or assets that are available for emergency. No? Anything in between is considered, of course, moderate. So the last factor is to establish an investor's behavioral loss tolerance. So this does not have anything to do with the client's bank account, but more of on the psyche of our client. So under this is risk tolerance, risk preference, financial knowledge, investing experience, risk perception, and risk composure. So risk tolerance, this represents the maximum amount of uncertainty an investor is willing to accept when making a financial decision. So to be able to gauge this, we can ask our client regarding his or her risk tolerance and categorize it as very low, moderate, high, or very high. Next is risk preference. So basically, loss aversion versus risk averse or safety over returns. So the financial advisor may find that categorizing an investor's risk preference as follows is useful in the risk profiling process. So we need to know whether the safety of the funds is more important than the returns. No? And then we can categorize it between maximize safety, mostly safety, mix of safety and return, mostly return, or maximize return. So it's a spectrum. Financial knowledge, this represents the combined financial information, facts, and skills an investor exhibits and uses when making financial decisions. So the financial advisor may gauge by checking how knowledgeable the client is when it comes to finance. So again, it can be between not at all knowledgeable, minimally knowledgeable, moderately knowledgeable, competent, or very knowledgeable. Investment experience. So here we can again ask for the client's investment experience. This basically refers to an investor's mastery of the financial topics and skills obtained through actions, behavior, or participation in financial and or investment activities. So none, very little, some, modest, or extensive. Then risk perception. This refers to a judgment an investor makes or feels regarding the severity of risk in association with the broader economic environment. So the typical question that we should ask our client is, for example, how risky is the stock market? So the client can answer very risky to very safe. So this will give us an idea of how our clients perceive risk. And then risk composure. So this refers to the likelihood that in a perceived or actual risk, actual crisis, an investor will exhibit behavior fundamentally different from our past actions. So we can ask our clients how he or she reacted to investment losses in the past, no? And then the client can answer whether they sold the investment, did nothing, or purchased more. No? So here we can see how if they have low risk composure, moderate risk composure, or high risk composure. So putting that together, is this behavioral loss tolerance scoring sheet. No? So if you want, I can give you a few minutes, to answer this, and so that we can find out, what's your tolerance, for losses. No? So I'll give you like a minute or so to answer this. So the first question. What is the investor risk tolerance, or willingness to take on risk? So you can answer very low to very high. Next, what is the investor's preference when holding risky assets? So maximize safety or maximize return? How knowledgeable is the investor about financial investment concepts? So how knowledgeable are you? Not at all knowledgeable or up to very knowledgeable. How much experience does the investor have with investment products? So none to extensive. No. What is the investor's perception of riskiness of the stock market? Very risky or up to very safe? And then the last one is the in the past, when faced with investment losses, what actions did the investor take? No? Or what did you take? So did you sell your investment? You did nothing, or purchase more? No? So once you're able to answer it, you can total the score, and then we can see the result. No? So if your score is between 6 to 13, you have a low tolerance for losses. 14 to 22, moderate, and then 23 to 30, high. No? So maybe you can share the results in the chat box, no? If you did the test for yourself. So how do we reconcile the IRP to a portfolio strategy? No? So once all the factors have been assessed, independently, the financial advisor can develop an IRP that will inform the portfolio recommendation, which is of course part of the IPS. No? Sometimes the IRP may reveal conflicting factors that require our professional judgment, to reconcile. So the following are examples, to see what we need to do in case the risk need, the risk taking ability, and the behavioral loss tolerance of a client is not consistent. No? So first example, the client's risk need is high, but the risk taking ability is low, and the behavioral loss tolerance is high. No? So here, given that the risk need is high, but the risk taking ability is low, we may need to ask our client to reconsider their goals. No? Kasi basically the risk need and risk taking ability is not matched. No? So the investor's risk need cannot exceed the investor's risk taking ability associated with the goal. Reconciling these two factors require that the financial advisor counsel the investor to reconsider the goal and or his or her savings rates. No? The next one, when the client's risk need is low, but the risk-taking ability is high and the behavioral loss tolerance is high. No? So we don't have any problem here. No? So a lower risk need can be discounted when both risk-taking ability and behavioral loss tolerance are high. No? So the client has more room to take on risk and is willing to do so. No? But the risk need is not that high naman. So the client can just opt to invest in relatively safe investment. Next, the risk need is low, the risk-taking ability is high, but the behavioral loss tolerance is low. No? So here, again, it's consistent, no? Given that even though the client has the risk-taking ability, he or she is not willing to take on risk anyway, no? And then the risk need naman is also low. So higher risk-taking ability can be discounted when both the risk need and the behavioral loss tolerance are both low. No? So the next example, the risk need and the risk taking ability are low, but the behavioral loss tolerance is high. No? So here, it's consistent with the risk need, no. Even though the client is willing to take on more risk, but his or her ability is not uh it doesn't match that, no. So they're both low, and then the risk need is low, no. So it's basically matched, no. So higher behavioral loss tolerance can be ignored when both the risk need and risk taking ability are low. The advisor may need to coach a client to overcome her behavioral tendencies to take risk in light of the realities of the client's risk need and risk taking ability. And also, the financial advisor should not recommend a portfolio allocation that exceeds an investor's risk taking ability, no? Risk-taking ability sets an upper volatility bound to a portfolio recommendation, because risk-taking ability changes, especially as the goal time horizon shortens. Now, this factor must be reassessed regularly. In this example, the risk need is high, and then the risk need and the risk-taking ability are both high, while the behavioral loss tolerance is low. No? So here, even though the risk taking ability is high, and then the risk need is high, no, but the client is not willing to take on more risk, no. So here we cannot force the client, no, to adapt, or to say na you have the ability to take on risk, then you should take on higher risk. What we can do is we can of course educate the client, because maybe the reason why he or she doesn't have the willingness to take on losses, or doesn't have the willingness to take on risk, is because he is not familiar, or he is not educated in terms of investing. So low behavioral loss tolerance can never be ignored. However, however, a financial advisor may conclude that the appropriate client counseling and education can be used, no, to nudge an investor into higher risk portfolio when the risk need and risk taking ability are high. So the word here is nudge, no, not to force them to take on higher risk. So another important factor when coming up with an IPS is choosing a proper benchmark, no. So the reason for that is you need to have a way to define success, no. So how do we define success, no? So medyo deep. So one important element in the fair representation of investment performance is the choice of benchmark, no. So for example, my fund is an equity fund, and the benchmark I use is for time deposit. Then of course, it is not consistent, no? It's not fair, no, because I can easily beat the time deposit rates, no, when I'm investing in equities. But I think that's not correct for the past couple of years. But most often the time, that will be the case, no. A benchmark should be a focal point when evaluating a strategy, no. So for example, when you hear overweight, underweight, that pertains to the benchmark, no? And then lastly, the thoughtful choice of benchmark will enhance the performance evaluation of the investment strategy by clearly defining expectations and success. So when you're handling a portfolio, the relationship between your portfolio and the benchmark could be generally fall under these three categories, no. The first one is benchmark relative, no. So this is applicable to passive and active investment strategies, no. So investment decisions are made relative to the benchmarks, weight, exposure, and risk. So this is where the overweight, underweight stock comes in. And then if you have a concentrated strategy, basically your fund is benchmark aware, no? So investment decisions are not as closely tied to the characteristics of the benchmark, although the benchmark typically represents the segment of the market from which securities for the strategy are drawn. And lastly, for high conviction strategies, basically you're benchmark agnostic, no? So investment decisions are not made relative to the benchmark at all. So what are the criteria, no, when selecting an appropriate benchmark, no? So a benchmark is appropriate if it reflects the fund's investment mandate, objective and strategy, no? So the key things that we need to look at is that the benchmark should be of course be specified in advance, no? So we don't want the rules to change in between the game, no? So the benchmark needs to be set upon account opening, no? The benchmark should also be relevant. So the benchmark reflects the investment mandate, objective, or strategy of the fund, no? it needs to be measurable. So the benchmark is quantifiable. No? So there are a lot of things that we need to know. The weights of the constituent stocks in the benchmark, the day-to-day movements, etc. No? It should be it shouldn't be it should be unambiguous. The constituents of the investable universe can be clearly identified and priced. No? It should be representative of current investment options. No? Meaning, the firm can be is allowed to invest in the constituent stocks that are included in the benchmark. Accountable, meaning the firm that selects the benchmark and should be accountable for any deviations from the benchmark. The benchmark should be investable, meaning it is possible for the fund manager to simply copy the benchmark, or to simply hold the benchmark. And then, of course, it should be complete. The benchmark should provide a broad representation of the segments or the sectors of the market to which it pertains. There is a bit of a trade-off in the last two, between investable and complete. So the firm or the manager should be able to balance the trade-off between the two. So a more complete index can provide broader, more diversified performance, but it may be less investable. On the other hand, if an index that has fewer and or more liquid securities will be more investable, but it is less complete, rather compared to the broader index. So an example would be choosing between the PSEI or the PASHUR or the Philippine All Share Index. The reason for that is that the PSEI is basically is constitute the 30 biggest companies in the Philippines, while the All Share Index includes illiquid names or smaller companies that funds typically can't invest in. So what are the typical benchmark that are used? So market indices, of course, the PSEI, S&P, etc. We can also use absolute value or target return. Example, hurdle rate or CPI plus X%. And then lastly, peer groups and manager universe. So this is relative performance. So we compare our performance against our peers. Other lesser used benchmark are return-based and return-based, factor-based ETFs, etc. What if there is there's no applicable benchmark that we can use for the mandate? So the CFA Institute advises that the firm must disclose why no benchmark is present. So the example is this. So because the composite strategy is absolute return and investments are permitted in all asset classes, no benchmark is presented because we believe that there is no benchmark that reflects this strategy. However, we should also check our local rules and regulations, as some investment vehicles such as UITFs are required to have a benchmark. So we cannot set up a UITF without a benchmark. So with that, we were able to gain some knowledge on how to be able to prepare an IPS for our clients. So what is the importance of having an IPS? So well, the investment policy statement serves as a strategic guide to the planning and implementation of an investment program. When implemented successfully, the IPS anticipates issues related to governance of the investment program, planning for appropriate asset allocation, implementing an investment program with internal or external managers, monitoring the results, risk management, and appropriate reporting. The IPS also establishes accountability, which is very important, for the various entities that may work on behalf of an investor. And perhaps the most important part is that the IPS serves as a policy guide that can offer an objective course of action to be followed by the fund manager during periods of market disruption, when emotional or instinctive responses might otherwise motivate less prudent actions. So basically, if you fail to plan, you are planning to fail. So this is the part where I leave you with a quote stripped from the internet. So investing is a journey of self-discovery. It reveals your relationship with money, your tolerance for risk and your ability to stay disciplined in the face of uncertainty. No? So moving forward, I hope this lecture will help you guide your clients, no, as they embark on their own investment journeys. With that, I thank you for your time and I open the floor to any questions.
All right, thank you so much, Mr. Raf Palmahir, our speaker for the webinar Investment Policy Statement. For those who have questions, please send them over in our group chat. I'll be moderating the questions. While I was listening to the webinar, the benchmark that Raf mentioned about, I was reminded with the acronym, for choosing a specific benchmark of a fund. When, of course, everybody can relate if you studied for CFA. Benchmark, samurai. So you know that a benchmark is a good benchmark if it checks the samurai checklist. S stands for specified in advance. A stands for it's unambiguous. I'm sorry, it's accountable. M stands for it's measurable. U, unambiguous, are representative of current investment outlets, and accountable. So the IPS also holds the fund manager accountable from keeping their investments in line with the signed investment policy statement. So in the event that, for example, the fund manager exceeded the maximum limit, for example, for equity, nakalagay 30%, but the fund manager exceeded by 10%, the fund manager will be held accountable. Bakit ka nag-deviate from the current investment policy statement? So that serves as the Bible, where the fund manager and the client can,
I
check
didn't know
and then
about
rebalance.
samurai, Brett. It could have helped me in the exam.
Yeah. I think that was level 3 or 2.
Yeah, level 3, I think. Yeah. Samurai pala
samurai.
yun. Ganun pala. I didn't know about that.
Yeah. And then the SMART goal, right?
Yeah, smart
Specific,
goal.
measurable, achievable, realistic, and timely.
So CJM, I believe, has a question in the chat box, Brett.
So we have a question from JM, our colleague from Security Bank Trust. Thanks, JM. How do you deal with clients who want to modify their investment policy statement very often? Very true for some of our clients, Raf.
I
How do we
believe,
deal with them who
yeah,
are very, wants to modify very often?
yeah. So if the client wants to modify their investment policy statement, that means they're coming from somewhere, no? So we need to know ano yun, what's the reason why they want to initiate a conversation with us, no? So we need to oblige them, no? So even though it might be bothersome for us to update the investment policy now and then, we need to listen to our clients, no? Kasi things can change quickly and we need to update their IPS on those changes, no? So JM, you need to practice patience, no, to our clients who wants to change, to modify, no. And then of course, maybe to have a more complete and comprehensive IPS for clients. Again, we need to collaborate, no? So it's just not the sales team, but also the other departments of the trust, no? So of course our legal department or our fund managers, no? So we can collaborate to be able to come up with a better plan for our clients.
Yeah. Or baka mali lang yung kanyang suitability questionnaire. Hindi na-capture yung mga behavioral biases niya.
Yes. So that's very important, yung mga behavioral biases, no? Kasi of course there are clients talaga who we think can really invest in more risky investment to maximize gains, but they're not really willing to take on risk. So we need to respect that as well. But we can advise them, no? We can try to encourage them, no? Or to basically educate them, no? Why we believe that taking on higher risk is more appropriate for their goals.
Yeah. May mga clients kasi na matatapang, like during the crafting of IPS, like, are you comfortable with having losses of more than 5%? Pero
Yes.
pag after a year, may loss na 4.5%, magpapanik.
Yeah.
So those clients can be,
Yeah.
will be
Loss
going
averse.
back to you and then ask a lot of questions.
Yes. So I guess we need to explain to our client that sometimes taking losses is to the benefit of the fund, especially when yung what they call na ipit ka na dun sa investment na yun. No? So you may want to realize the loss na and reinvest somewhere else. No? So there are those instances, and it's better to explain it to our clients. No? So it doesn't mean naman that we don't realize the loss. We don't take in the loss. No? So it's just unrealized loss. No? And those investments can
Mhm.
down further. No? So sometimes taking the loss is the best action that we can take, no, for our clients.
Okay, I have a question, Raf. So
Sure.
so far wala no other questions. How is it different an IPS of a corporate account versus
Mm.
an IPS of an individual account? May difference ba?
There are some difference, especially on the specifics of the IPS. No? So of course, an individual and corporate can have um different goals, no, way different goals from each other. No, so individual can ano lang, look at retirement or something that they can leave to their family when they pass, no. And then corporates, of course, looks at, like, for example, retirement funds, no, to be able to fund the retirement liabilities of the company, no. So
Mhm.
there are different there are big differences from the two, no. And of course, liquidity or the capability to take on risk, of course, the wealth of an individual um is relatively smaller to, like, for example, the balance sheet of a company, no? So those things, there are talaga maraming differences, no? But there are also a lot that are the same naman. Like, for example, the investment universe, no? So for individual, if you do an IPS, it of course eventually is going to be invested in bonds, uh, equities, etc. No, which is the same for our corporate clients as well. And then of course there are tax implications, and then those
Yeah.
things which I'm not really
Mhm.
really an expert on. No? So yeah.
Mhm. Yeah. Okay, I think we're through with the question and answer questions portion. So we would like again to thank our speaker for the investor series investment policy statement by Mr. Rafael Palmahil, a CFA, an equity fund manager from Security Bank Trust and Asset Management.
Thank you very
To our participants in this webinar, please turn your attention to the screen for the QR code. This is our survey. We would appreciate it if you scan the code and answer our quick survey. It will take you 1 to 2 minutes to complete. All right, I hope you were able to scan our code. Last but not the least, let us turn on our videos. If you can turn on your videos, no, for the photo opportunity with our guest speaker for today. Okay. I'll be counting, no, to check first. Ako na lang mag-take ng picture. Okay. 1, 2, 3, smile. And then one more. 1, 2, 3, smile. There you have it. Thank you so much. Again, we would like to thank our sponsor for this webinar, silver sponsor FTI Consulting Philippines, and our bronze sponsor DNL Industries Incorporated. This concludes our webinar and accept our sincere appreciation for your time and effort for joining